Welcome to EconTalk, part of the Library of Economics and Liberty. I'm your host, Russ Roberts of George Mason University and Stanford University's Hoover Institution. Our website is econtalk.org, where you can subscribe, find other episodes, comment on this podcast, and find links and other information related to today's conversation. Our email address is mail@econtalk.org. We'd love to hear from you.
Before we start this week's podcast, we want to let our listeners know that EconTalk is a 2008 Weblog Awards finalist in the category of Best Podcast. Voting begins today, January 5th, 2009, and continues through January 12th. You can vote once a day. To vote, visit our homepage, econtalk.org. There you'll find a link in the upper left-hand corner of the page that will let you vote. Thanks for voting, and thanks for listening. And now for this week's podcast.
My guest today is my colleague here at George Mason University, Pete Boettke. Pete, welcome back to EconTalk.
Thanks, Russ. Glad to be here.
Our topic for today is the Austrian theory of business cycles, which and the role of monetary policy in that in the cycle phenomenon. And I'm fascinated as someone who knows virtually nothing about it. I'm an Austrian on the micro side, become increasingly so and through my interest in Hayek. But I don't know much about the macro side. So our topic for today is to try to explore that for me, the beginner, and I suspect some of our listeners as well. So start us off. What is distinctive and what's unique about the Austrian view of the business cycle?
Well, we actually have a good place to start because the Austrian position is one that says that while there may be macroeconomic problems, there's only microeconomic explanations and microeconomic solutions. And so what I mean by that is there are phenomena of unemployment, inflation, these sort of aggregate phenomena, but the causes of those aggregate phenomena should be rooted in the choices that people make. And so what the Austrian theory of the trade cycle is, it's a combination of a bunch of different factors that flow out of that, one of which is the nature of the way money works its way through the system, which money doesn't just, an increase in the money supply doesn't automatically lead to an increase in the price level tomorrow. It leads to relative price changes, which if there's no other intervening changes would equate to the quantity theory, but it doesn't happen just overnight, instantaneously.
The quantity theory, let's review the quantity theory. The quantity theory goes back to Irving Fisher and then was revitalized by Milton Friedman. And the quantity theory is to some extent an accounting identity that MV equals PT, the amount of money times the number of times V is velocity, the number of times it turns over, equals the aggregate value of economic activity, P times T. T is transactions, P is the average price level. So in the monetary theory, if M goes up and V and T don't change, then P goes up, and that's the simplest, most basic argument in favor of a theory that says inflation is everywhere and always a monetary phenomenon. But Friedman and others, in recent years especially, the others, have worked on the role of expectations. Friedman's empirical work on monetary policy was that monetary policy had an influence with a long and variable lag. So it didn't suggest that prices or anything would adjust overnight unless, I think, correct me if I'm wrong, unless people expected that and it was well understood and everybody knew about it. But since in reality they don't, and they confuse price signals with that might be real versus nominal ones that are just due to inflation of the money supply, then you can get real effects from monetary policy. That's a Chicago classical view, correct or not?
Yeah, I mean, there's going to be a subtlety in the discussion here because Mises, in his book Theory of Money and Credit, fully endorses the Fisher position against monetary cranks, what he called monetary cranks.
What are those?
The belief that you could solve a problem by printing money. So if you see poverty in the world, print more money. If you see, so these were sort of, the people that didn't see a connection between, say, money and inflation or the distortionary consequences of inflation. And if you put yourself back in the mindset of the early 20th century, we can see that several countries went through these very difficult bouts of inflation, hyperinflation, because of this kind of idea that you see a problem, you print money. The problem of poverty, we don't have enough money. And so the
confusion of the real and monetary side of the economy.
Right. And so there was this classical dichotomy, which is reals affect reals, nominals affect nominals. And the quantity theory of money sort of was very important. And Mises fully embraces that. But what he says is we don't want to have a mechanical interpretation of the quantity theory, which would somehow lead people to believe that money was just a veil in the economy and couldn't have real irrelevant and couldn't have real impact. And so Hayek later on often referred to this as money as a joint, and either it's a tight joint in which it's just a veil, or it's a broken joint, which Hayek argued, the Keynesians argued, or what he argued was it's a loose joint, which is sort of similar to Friedman's idea of the long and variable lag. That while there's a jointness between the increase in the supply of money and the price and the activity that's going on in the price level, it takes a while for the adjustments. And so what the Austrian focus was on the monetary side was to look at the relative price adjustments and to see and that's how they get these injection effects, which they get. The argument goes back to a man named Richard Cantillon, who argued long
time ago,
long time ago,
right? Yeah. Maybe?
And what he argued was money, comes in at a particular point in the economy, and then it ripples through the economy, like the way that you would if you threw a pebble into a pond, the way the ripple would come all the way out. If we can just hold off getting to the expectation stuff till later, because there is a history of thought idea here. But Bob Lucas did, when after the rational expectations revolution and new classical macroeconomics did take on, Lucas wrote a book called Understanding Business Cycles. And at the core of that was his attempt to sort of translate into his language the way Hayek told the business cycle story, which was the confusion between relative price and general price. And that's how he gets his island model. And so we don't know, we get confused whether or not it's a general price level change or it's a relative price level change. And because of our confusion, that leads to distortions in the pattern of exchange and production.
Okay,
but
let's talk about, unless you want to delay it, let's talk about what you mean by relative price adjustments, because I think some people are not going to understand that.
Well, a particular price of a particular commodity changes not all commodities at once. Right. So in a lot of ways, for Milton Friedman to sort of defend the classical dichotomy, reals affect reals, nominals affect nominals, and to challenge the idea that you could just throw money at things, Friedman often explained it in terms of a helicopter, right? If you drop money on the system as a helicopter, what would happen to the price level, right? It would all come up, and so we might have more money, but the prices would adjust in general to reflect the new money, and therefore it wouldn't have the effect.
Our standard of living wouldn't change.
Right, and so we're not fixing poverty by doing that, right?
So, but the question then is, what's the Austrian take on that? The Austrian take is essentially that the price signals in the way I understand it, the little I understand it, that the price signals in the economy get distorted,
right,
and cause real effects that are bad as a result of this inflation. So is the argument that the money doesn't fall everywhere equally because you can't have a real helicopter drop?
Right. That new money is injected into the system at a particular point and then works its way back out through the system, like I was saying with this ripple effect. So the first thing is the non-neutrality of money. That's the first proposition in the Austrian idea. Now,
so explain that.
Meaning that money is not ever sort of neutral in the sense that they adjust up instantaneously and all the effects go out. That since money is one half of all exchanges, goods trade for money and money trades for goods. Goods don't trade for goods in a monetary economy, right? That would be barter. Right. That money is one half of all exchanges. If you screw around with money, you're going to screw around with all the exchanges in the economy because you're going to get these relative price effects. Sort of just like normally, when you and I would talk about microeconomics, we would talk about relative price effects as how the market works. Well, if we distort how the market works, we're going to get distortions in the pattern of exchange and production. That's the basic idea.
Okay, now lots of things distort the pattern. Taxes distort the pattern. Subsidies distort the pattern. Preferential barriers that are set up. Those cause resources to flow in ways they wouldn't otherwise flow. So the suggestion here is that monetary policy does the same thing. And my response as a skeptic would be, okay, so what? But why is that such a big deal?
Well, I think what you've
added another one,
right? But you have to combine that then with the next aspect of things, which is the idea of that the capital structure is made up of particular goods, not just K, not just a homogeneous thing that we measure in aggregate, but particular goods and goods that are combined together that have. They have their multiplicity in their uses, but not complete uses. So they're multiply specific.
So what does that mean?
Okay, so I can't turn a beer barrel plant into a soccer ball plant overnight. The particular goods that go into making beer are not the same as those go into making soccer.
Let me talk about that in a little more basic way, and bring in the critique I think you're making. We often know about the amount of capital in the economy, and we talk about how capital is a complement to labor, so it enhances the productivity of labor, which is obviously true. You work on an assembly line, you can make a lot more cars than if you work by yourself with a chisel and a welding equipment. So, as I understand what you're saying is that if we look across the whole economy, at any point in time we have a certain amount of capital, which we would aggregate through some very crude rule of thumb about dollar value and prices and trying to figure out the quantity of capital. So we're pretty confident we have more capital today than we had in 1920, and the quality of it's better, whatever that means. But if we have and we also talk about how capital flows in response to return, right? So what I understand this critique is then, the Austrian critique of this is that, well, that's all well and good, and over time that's probably true, but at a point in time, and I want to take a more timely example than the soccer ball beer plant issue. If you have a car factory and you say, well, if the car factory gets shut down, if the owners of the car factory, the managers of the institution, the organization are not doing well, they'll go out of business, and the resources will flow to their next best, highest valued use. In the case of American car companies, it's probably toward another car company, a foreign car company that would be here, or toward a foreign car company overseas, or to something else. And your claim is that the assembly line for a car company is not very liquid. The money is liquid, but the assembly line itself, the investment that went into that is only good for making cars. Is that the point?
Or close substitutes to cars, right? I mean, they could be transformed to make trucks or something like that, but they can't be transformed to make bubble gum or some other good
windmills.
Windmills or something. So I think that the reason why this
is that significant?
Well, the reason why this is important is because if the signals that led to the pattern of production and the investments in the capital goods were false, and then proven to be false through as the adjustments are made and markets reveal them to be false, then the investments that were made in those machineries are particularly costly. So the example I use all the time when I'm trying to teach is I use the difference between when you have a little kid, anyone who's a parent has a little kid, they go through a dinosaur phase. And there's two different ways to make sort of dinosaurs with your son or daughter. One of them is with Play-Doh. All right, and you could make it and shape it, and the other one is with Legos. And Legos are these little blocks that require particular patterns to fit together in a very, sort of difficult way. You got to get the sheet out and follow them. With Play-Doh, you kind of just shape it. It kind of, and then you say, little Steven, do you think that looks like a dinosaur? Isn't this a brontosaurus? And he says, no, Daddy, it looks like a dog. And you go, okay, well, then you just smush, the different parts, and then you put the tail up or whatever, and you end up by getting a brontosaurus eventually by pushing the clay around. Whereas if I had the Legos, I have to follow those instructions, because if I get to the end and I don't have a yellow little thing because I missed it, then I'm not going to be able to make the dinosaur. I have to go all the way back to the beginning. I want to suggest that the capitalist economy, the capital structure in a capitalist economy is more like Legos than it is like clay. But for modeling purposes, we often treat it as if it's like clay. Mathematically rather than as the Legos. Now, the reason why this matters is because the costliness of the mistake. Let's say I'm not paying attention to the signals on the instructions for the Legos. I got to go back. I got to rip apart, go back to a particular part, and then build back up again. But literally,
and in the meanwhile, there's no entertainment value.
Right.
And in the real side of the economy, there's no production taking place. Right. Is that adjustment?
Whereas with the clay, it seems easy for me to fix mistakes. Mistakes are easy, so to fix. Not completely easy, but relatively.
If you bake it, so it's a little bit strange example. You're talking about you're assuming we don't bake the clay. In which case, you're really in a lab.
I started with Play-Doh, right? So it's already there. I already started with Play-Doh. So we combine the monetary side and its effect on prices, and those are like the instruction sheets for the Legos. And then we have the capital side, all right, and then that's going to be like the particular goods and services that build up the capital structure in the economy. And then you have to ask, okay, well, what's the transmission mechanism by which these things are connected? And that's going to be through the credit market. And if you combine these, where financial intermediation, right, where you're going to have the savings of some become the investment funds for others. And if somehow the interest rate is artificially lowered from what it would have been had the regular pattern of intertemporal decision making, that is my savings and consumption trade-off, so the savings of some get transmitted into investment funds for others. If we artificially lower the interest rate, it appears to be that I have more savings in the economy than I actually have to justify my investments. So what used to be an unprofitable investment at a higher interest rate now appears to be a more profitable investment. I buy into that, borrow the money, invest in these things, which are in fact a capital structure. But as the economy's money works its way through, remember it's an injection, then it ripples through. So as people get the new money, right, that sort of, they reassert their savings and consumption trade-offs, and the scarcities, real scarcity of savings or whatever, come back, and as a result, what appeared to be profitable proves itself to be unprofitable, and then you have the boom and bust. So that's the simplest way for me to try to explain, the boom and bust. And then over the years, people have used, various different analogies. The hangover theory, if you drink too much, you're happy at 11 o'clock at night, but you're not very happy at, 5 the next morning, right? That's the boom and bust cycle.
Let me stop for a minute. I want to just clarify a few things that you went over a little bit quickly. First, a very important idea that I don't think we can talk too much about these days, which is what financial intermediaries do, which is basically at any point in time, there's a group of people who have more income than they want to consume, and there are other people who want to consume more than their income. And we need to match those folks together, and the way they get matched together is through banks, investment banks, the stock market, and other things. Other financial institutions are essentially matchmakers. They're middlemen, to go back to the Michael Munger podcast on the topic. What they're doing is they're matching those people together, and the way they match them together is through the way that market is relatively happy is through the interest rate adjusting, right, so that at a high enough interest rate, I'm willing to give up some consumption today for consumption tomorrow, and you in turn are willing to take consumption today and pay me back down the road. And of course, once you have that, as soon as you have that intertemporal across time activity, you introduce risk and uncertainty, because there is the possibility that you will not keep your promise, you will not repay. And so the market tries to develop mechanisms to make that more likely than less likely, which would be I look into your past, I have collateral, which would be the most obvious thing I would look for. And then, unfortunately, in recent years, the third thing that's happened is that I look for people outside of this transaction to guarantee it, whether it's the government or a private mechanism, a credit default swap, which is what we've been talking about with Arnold Kling. So the way I understand what you're saying then is that monetary policy comes in, artificially lowers the price of future consumption the interest rate, below what it would normally be, inducing too much investment.
Well, it's
too much
or malinvestment.
Well, that's the point I want to distinguish.
Investment in activities that otherwise wouldn't be profitable, but now appear to be profitable because of the interest rate. So it's not necessarily the case that you would call it overinvestment as much as you would call it a malinvestment.
Yeah, try to go into that a little bit more. Because your story was a relative price story originally. But this to me seems more like just price is just overall, the interest rate being a very distinctive price because it affects all intertemporal decisions just being distorted. Is that a sufficient story to get us the boom and the bust?
Well, I think, again, the way the particular transmission mechanism works in the system, the money is injected in a particular stream of things. Now, one of the things that would have to be modified in the development of the Austrian theory is you got to remember is that they developed a theory, mainly Mises and Hayek developed a theory in the 19teens, 1920s, and 1930s. Okay, and it's Wicksell, Mises' theory of the cycle. Knut Wicksell is a Swedish economist, and there hasn't really been that much further development on the theory in the nitty-gritty aspects of it since that time. But a lot have changed in our financial institutions. For example, we have levels of consumer credit which were not necessarily the case that they had at that time.
Unimaginable,
right. So when they were looking at things, they were mainly looking at the way in which loans were made to particular businesses. And so you would get a kind of, say, a construction boom and then a bust, right? And that's how they explain 19th century and early 20th century booms and busts. Now what we would have to do is we'd have to examine more the particular details, institutional details, to look at the way in which consumer markets can get artificial. This is why when you said the thing about financing consumption, the other way to look at it is also financing investment, and their focus was all on investment. But in more recent years, you would have to talk more about financing consumption behavior that we've had over the years, and then the theory would have to be modified. So that's one of the reasons why or at least the application of the theory would have to be modified. But that's why I emphasize the idea of the particular points rather than a particular narrative.
I understand.
Which is if you see money as a ragged process rather than an even process that adjusts up instantaneously, if you see the capital structure as made up of particular goods and patterns of goods combined together that have,
homogeneous.
Right. And then what you do is you end up by seeing the distortions that result because of the issues, the sort of confusion in the prices of those particular goods. Now the question is, why is it that we emphasize monetary policy as opposed to, say, the other microeconomic restrictions that you raised, taxes and things like that? It's because money is, even though we're talking about relative prices, money is the one thing that affects all the exchanges in the economy. So we want to put the focus to explain the cluster of errors. Businessmen didn't all of a sudden just get stupid. They made a mistake for a particular reason, and the reason is they got confused by the signal. And now the question becomes, in the history of economic thought, whether or not that confusion can fit with the later developments of our understanding of expectations, which is what you raised before. And the only thing I would say about that is the rational expectations model. So if you think about the way the theory went, it went from adaptive expectations in Friedman, which has this kind of lag built into it.
Adaptive meaning you don't look too far ahead. You just kind of see what happened recently and you try to adjust without anticipating what all the adjustments might then entail, and that would normally affect what you'd want to do if you looked ahead.
And whereas Lucas had, you forecasted the future and then correctly, and then wrote back into your actions today. And so that would end up by nullifying a lot of this stuff. Mises back in the 1940s introduced an idea of what he called elastic expectations, in which he anticipates some aspects of what Lucas's argument is. But he kind of argued that, and he also argued in his 1912 book what he called Lincoln's Law. He said you can fool some of the people some of the time, but you can't fool all the people all the time.
Right.
And so in that sense, if you have anticipated inflation, the prices are investors are going to adjust up, and then all this stuff, these distortions are going to be recognized. But the real problem is that you can't. Goes back to the way Lucas sort of did this. Is that it's very difficult for businessmen to sort out whether or not it's a real change in the consumption and demands and supplies of a good, or if it's caused by these distortions. And so it always pays for you to get in during the credit expansion phase and then get out if you could do the right timing. But the point is that the difficulty of picking the right timing. It would have been great if in August we all would have, got out of the stock market completely, right? It would have been a lot better for us, or maybe even 6 months earlier than that. Yeah.
Let's apply some of this to what's going on today in the housing situation, because it's obviously very relevant. We interviewed Robert Schiller here. I interviewed Robert Schiller, and his story is just, people make mistakes. They get exuberant, and they just all of a sudden prices start going up. And once they start going up, once you see an appreciation of an asset, it even becomes rational. Even if there was nothing rational about the underlying cause of the initial appreciation, you can rationally then start investing in that asset as long as you get out before the bubble pops. Subsequent to that, I started doing some thinking and reading, as listeners know. And to me, the 1997 tax reform was kind of an important distortion that got this process started. All of a sudden, we took an asset that had been taxable unless you rolled it over into a new house. So a capital gain on your house was taxable unless you rolled it over. And in 1997, the government changed that law and made it so that you could get the cash out. And you could do it on more than one house, actually, which is really quite an amazing thing. That pushed up the demand for housing, with other things that we might talk about, the government-sponsored enterprises, Fannie and Freddie, the Community Reinvestment Act. Those things all had an effect on the demand for housing. I've started to believe that perhaps the 1997 Tax Act was the single most important thing to get it started. But that clearly distorted the choice. This has nothing – I don't think it's anything to do with this. Is straight standard price theory. Right. That just changed the relative price of housing, the return on housing relative to other assets, and money would normally pour into it. Then in 2001, Alan Greenspan lowered the federal funds rate to its, I think, 40-year low of 1% and kept it there for 2 years, worried about a recession from 9/11 and the tech bubble. Right. And as a result, adjustable rate mortgages got very cheap. The teaser rates, the opening introductory rates, and that made it extremely attractive for people to have to borrow money to buy houses who hadn't otherwise been willing to do that. So my question is, and that clearly poured an enormous money, those two things, and with some other stuff, and then the securitization phenomena, those things made it an enormous amount of money, trillions of dollars poured into housing rather than to other things that would have been more productive. That clearly is an enormous social blunder by itself. That was, and I want to emphasize that the trillions of dollars that went into creating new homes and bigger homes and refinancing of expansions of homes and renovation, that was capital. It's very important relative to your earlier story that normally would have gone into something else more productive, health innovations, entertainment innovations, whatever they would have been. And then suddenly that capital was not available for those things. Instead went into housing. It's nice to have more houses. It's nice to have bigger houses. But that choice we made was artificially induced by those policy changes. But that just would have been a mistake as opposed to a catastrophe. The catastrophe has been coping with the adjustment as interest rates rose and as people who had borrowed the money couldn't pay it back in a very leveraged, highly borrowed environment, as we've talked about in a number of other podcasts. How does that Austrian story fit in with that? Because the way I understand a lot of the Austrian response to this crisis is it's all the money supply. It's all Alan Greenspan. He pushed interest rates too low for too long that artificially pushed capital into certain areas. But I think the key is, for me, the problem I have with that explanation is it pushed capital into a particular area, which was housing. I mean, Fed's been jerking interest rates around for since 1913.
Right.
And the Austrian critique of the central bank activity is, they distort things. Well, through most of that time, it's true. Sometimes we had some recessions. Sometimes they were horrible, like the Great Depression. But in the last 30 years, they've been pretty mild. Now, is that only because it was building up like a powder keg, or was it just because of a disastrous lowering for too long, or is it more this interaction between monetary policy and tax policy or something else?
Yeah, I mean, I think, Russ, that the explanation that you gave, if I was not here looking at you and someone would just said that, I would say, that's the Austrian story of the boom bust compounded by, a bunch of other policy mistakes. Because in order to basically light the powder keg on all these things, you have to have these other restrictions. So the other day I gave a talk at the Atlas Economic Research Foundation, and one of the things that I mentioned in there was that I don't see any reason why the Austrian story and the monetarist story have to be at odds with one another. In fact, if you look at the way they describe the Great Depression, they're describing two different parts of the Great Depression.
You mean the Austrians and the Chicago monetarists.
So let's just take, Murray Rothbard and Milton Friedman as representatives on this. Rothbard's story of the credit expansion and then the boom and bust really covers the period of time of the 1920s. Friedman's story is in the early 1930s and the Great Contraction. So there isn't really a conflict here about whether or not inflation creates problems or deflation creates problems. Both of them are distortions in monetary policy caused by government policy mistakes. But in both stories, both Friedman and in Rothbard's story, when you get details about it, the contraction's not enough and the inflation's not enough. You have to augment it with things like what Robert Higgs talks about, which are all these microeconomic restrictions that prevented the market from being able to adjust. Adam Smith has a wonderful line in The Wealth of Nations where he says that the power of self-interest and the market economy is enough to withstand 100 impertinent follies of human lawmakers, right? But the problem is that when they get to be 1,000 impertinent restrictions, maybe the market can't absorb them enough and get around them. And so I would tell the story the same way that you just told it. I would say that you had credit expansion after 9/11, a monetary expansion, which fueled a lot of this. You have distortions in the microeconomic system that pervert the incentives and pervert the signals that goes on, and that it's a combination of these factors which generates the difficulty of the problem that we're dealing with today. And so in that sense, I don't see that as being, you see, Austrian economics, I don't think is economics any different than just good old economics. And at the end of the day, good old economics is relative price economics. And so what are the factors that are impacting on the relative prices that agents face in their choices? And to me, and what would augment those things. So, the monetarist Austrian debate is really one of the relative negative impact of deflation. Whether and my own view, some Austrians don't hold this view, but my own view is that the best in the Austrian tradition held that inflation is a ragged price process of adjustment which causes distortions more than just shoe leather costs, and deflation is also a ragged process which causes, which we don't have instantaneous adjustment of prices going downward. The Austrian argument on the deflation, and I don't know if you interviewed George Selgin in the program, so the Austrian argument that is in a growing economy, you should, in fact, if you don't have expansions in the money supply, you should see a declining price level called increase in productivity norm. And so Selgin's basic idea is that, it'd be okay to have the price level less than zero, and
inflation be
less, and so that's fine, that's fine. But the problem is when you basically suck the money supply out of the system, which is not the same as having productivity increases.
Slow, steady.
Yeah. What you have.
Let me just stop you there, because a lot of that's about the speed of adjustment. I want to just bring in your earlier point about the adjustment costs to the current situation. The mess that we're in today in the American economy, we're taping this on December 22nd, 2008. The mess we're in today, part of the mess, there's a whole bunch of it, but part of the mess is that housing prices were artificially high they need to fall. And one view says, oh, that's no big deal. So they fall, and some people lose money and some people win. The reason that adjustment is so catastrophic isn't the normal argument, which would be the human side, that people are going to lose a lot of money and that's going to be really unpleasant, because a lot of the people who are going to default on their loans didn't have any equity in their houses. There's not much of a tragedy. They were mainly renters masquerading as owners. The real tragedy, the catastrophic part of this, is that the adjustment itself isn't just, real prices adjust, some people win, some people lose. It's that a whole bunch of institutions made promises they're not going to be able to keep. And when those institutions are destroyed, it's not like the capital just flows to the new use. And it's not like, well, a new institution just springs up to replace the old one. We have holes in the capital system. They're going to make it hard for people to borrow and lend, and that's going to be very costly.
You got it on both sides. On the one hand, you and I are what we have is a strong prior, let's say, that markets are these amazingly resilient things. One man garbage turns into another man's treasure, overnight. He sees it, and so you unleash the entrepreneurial spirit. It's not like these resources are going to go into a black hole. They'll be reallocated somehow. But the process of reallocation is not so pretty.
Right.
And we've made it very difficult in this country. As I was mentioned to you before we started talking, I take the liquidationist thesis. I'm completely on board with that. But it's meaning that you just liquidate these
let some things go bank. Let things go broke.
Yeah, let them go broke.
The way I describe it is let prudent people who are prudent buy the assets that imprudent people misused.
Right.
But that's an easy thing to say because it's more complicated.
And it's also more difficult now because of the way the court system has evolved, the bankruptcy laws. I mean, it's not as easy as when the pizza house down the corner goes out if a giant corporation goes. But let me, the other thing that you have to, keep in mind on all of this stuff is that we are building in. What we've done is we've taken a market correction
in the current
situation, and because of our policy responses, increase the distortion of the incentives that actors have, and increase the regime or rule uncertainty that exists in the environment for investment, and prudent reallocation. And because we've done that, we've then exacerbated the problem. So if you think about the idea of the credit freeze at some sense, right, the credit crunch everyone's talking about. On the one hand, if you talk to people who 10, 15 years ago would have met the scrutiny of the loans and had, and gotten their loans, they didn't have a problem, still getting loans.
I think that's true.
It's the people in the last 10 years who have, because the standards collapsed, right? They haven't been able to get the loans again. And then we call that a credit crunch because we got used to having very, very low standards of easy credit as opposed to the older standards. I mean, think about when you and I first got married or had, or wanted to have, get a house. What did we confront? We confronted a 20% down. Mortgage, the mortgage couldn't be more than 1/4 of your, monthly salary, which meant, by the way, as college professors, that we weren't buying any big house or whatever, right? But nowadays, they moved it down to, to standards that, and we had, by the way, and go back, we had actually relatively secure jobs,
right?
Because a college professor is a relatively secure job,
even untenured. It's a relatively
when
usually you don't expect the college to go broke,
right? And you don't expect an untenured assistant professor to have to leave his job until at least 6 or 7 years, right? And so, but yet the standards were very high. Those standards all collapsed. And that, in order to explain why that happened, see, this is why I don't like the Shiller explanation. In Shiller's model, somehow individuals within the economy just had irrational exuberance. They just were way too optimistic. So it's a wild swing of optimism, and now we're hit with a wild swing of pessimism. Whereas the more microeconomic explanation asks, why did people? So it's not just a what question, what happened. It's also a why did it happen. And when you do that, you have to look at things like the 97 change in the tax. You have to look at things like the Community Reinvestment Act. You have to look at the lawsuits, for example, that were brought against banks for having standards that then, just because the lawsuit was threatened, now they're going to say, oh, well, we're not going to do that anymore. And so the New York Times had an article in Sunday's paper yesterday in which it tried to blame Bush for the whole thing and his strive to have community.
Part of the problem.
Yeah, and I'm not saying it wasn't, but it's not the whole problem, because actually these problems go back deeper.
Way before that. But let me stop you there, because I think when people talk about the credit crunch, it's actually, I think, the opposite of what you're saying. So, like your reaction, it's actually quite easy to get a loan right now to buy a house, as long as you go back to the old standards, which is 20% down. And it's a loan that's small enough to be guaranteed by Fannie and Freddie, which is under $417,000, because Fannie and Freddie now are being operated by the government as the way they were chartered to be run, I think, is the way they're being run now, which is conforming loans, conventional loans, people with decent credit and willing to put 20% down. And if you are in that category, you have no trouble getting a loan. But if you're not in that category, you have an incredible time getting a loan. So if you want to borrow $418,000, that market's not functioning very well. That's the first point. The second point I think people make is that banks aren't lending to each other, and they're not lending short-term to other economic institutions.
Right.
Now, I don't know whether that's really a big problem or not. Maybe they shouldn't be. It's part of the reason we're in this mess is because of this bizarre overnight market that Bear Stearns and others were in, which is what precipitated the policy response. I want to talk about that and get your perspective on it. Back in March of 2008, we had what was to me the 1997 Tax Act and other things were the thing that started the housing price explosion. Now, what started the financial collapse is the government treatment of Bear Stearns. And for those of us who have that free market prior and that tendency to believe that markets are resilient, we have to answer the question, and I don't think we can for both uncertainty reasons and maybe the facts. What would have happened if the government had not been the facilitator of the marriage of Bear Stearns and Morgan? So here's what happens. On a weekend in March, it turns out that Bear Stearns is bankrupt. Now, why is that? The reason they're bankrupt is for two reasons. They made a lot of risky investments in assets they thought weren't so risky, these collateralized debt obligations and mortgage-backed securities. Within Bear Stearns, there were two hedge funds that were investing in these assets, and it turned out they weren't as valuable as they had originally thought. They got marked down. So all of a sudden, this is the mark-to-market issue. All of a sudden, when it became revealed that the value of those assets was in fact dramatically lower than Bear Stearns had originally thought, all of a sudden Bear Stearns' financial position is much more precarious. And this is the other key point, all of a sudden a lot of the institutions that were going to bail Bear Stearns out overnight by lending him money suddenly said, whoa, wait a minute, I'm not so sure I'm going to get my money back. We're not going to lend them the money overnight that we've been doing to let them carry through their to the next day and survive this situation. Now, when that became known, Bernanke and Paulson said we can't let this happen. Now, at the time, I and others, you probably said, well, why not? Let them go bankrupt. Let them go out of business and let their assets be revalued by the marketplace. And the standard argument, we've talked to Arnold about this as well, Arnold Kling in another podcast, and I think it's still unclear what the answer is. The standard argument question, the question at the time was, well, but if we let them go bankrupt because of that big pile of regulations and court activity that's going to happen, the whole credit market's going to freeze up because they're tied in through millions of transactions to other financial institutions. And as soon as those assets are tied up in bankruptcy court, the whole financial system is going to lock up, and so they have to be bailed out, or in this case, semi-bailed out. The government guaranteed, I think it was $29 billion worth of their toxic assets to make a suitor come forward and be willing to buy them, Morgan. So what would have happened if the government had done nothing? That's the first question. And the second question is, that'd be one argument for our side, the market-oriented side. The second argument would be, well, the reason they were in this highly leveraged world was because of the mismanagement of monetary policy. But that, I don't find that a very convincing argument. To me, Bear Stearns should have been it's surprising to me that Bear Stearns and the other Lehman and AIG and others weren't more resilient. They put themselves in a position where they were prone to bankruptcy. So react to that.
Well, I think let me start with the second part and go and then come back to the first one, which is that I think that in order to understand the situation that these firms put themselves in, you have to go back again to the combination of policies. So the easy money policy following in 2001 simply adds fuel to the fire of already distorted microeconomic regulations that you sort of have already talked about. But a lot of those, which we haven't talked about enough, is in fact the government-sponsored entities like Fannie and Freddie, and the creation of the idea of a too-big-to-fail kind of idea. There is a moral hazard issue that people hear about nowadays, but I think it's a real one. If you privatize the profits and socialize the losses, it makes sense for a businessman, you or I or anyone else, to in fact engage in riskier environments. And the partial deregulations of the way they could engage in certain of their securities, these mortgage-backed securities, meant that they would sponsor a mortgage, then flip it and sell it and blah, 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 and all this stuff. And what you lose is you lose both accountability and, more importantly, calculability. You were trying to value assets which no longer were completely tied to a market. And so in this sense, you got further and further removed from the ability to engage in calculations over what the value of these assets were. And when they were revealed to be, in fact, not as valuable as we had thought they were, the only way you can get them back to being valued correctly would be to introduce the market mechanism. It's very similar, not identical, but analogous to the situation that I confronted in my previous life as an economist, which is a Sovietologist, when you had the breakdown of the Soviet system, in which you had a lot of firm assets which were quote-unquote valuable, but they didn't have a market valuation, and we just sort of, were making up an idea. They didn't have calculability. So why do you get privatization? You need to get privatization in order to be able to get market transactions so you can, in fact, find out whether or not these resources are valuable or not, which is one of the reasons why you would want to have quick privatization as opposed to the sort of plan which took place a lot in the 90s, which was put in a firm in there and try to figure out, like a Western firm, to try to figure out what the value of these assets were without them trading on the market. And so I think
hopeless.
Yeah, which is hopeless because you're caught in a valuation trap, and I think that that's in a weird way what happened because we set the rules of the game up in this country so that our investment banking industry ended up by losing accountability and losing calculability, and so they had to be confronted with that. Now comes to your second point. What would have happened? The counterfactual is always the toughest argument to hold, right? So what we do know happened was that various forms of bailouts and subsidies to keep afloat imprudent decisions were in fact allowed.
And created a credit freeze. Ironically, the thing they're supposed to be trying to prevent happened anyway, which is an argument for why we should have. I like the metaphor, pull the Band-Aid off quickly rather than slowly. Let the pain come immediately.
Ludwig von Mises used to say this line. He says, you don't – I don't know if Mises said it or my teacher, Hans Senholz, who was Mises' student, related to us, but he used to say, you don't cure a patient with bronchitis by shooting him in the chest. And, that would cure bronchitis, but it wouldn't leave the patient. And to a large extent, this is how I learned, by the way, the relationship between what I was saying before about the monetary expansion in the 20s and the secondary depression of the monetary contraction in the 30s. What the government did was, it ran over a guy on the street and then said, oh, we ran over someone, let's back up, and they ran back over him again, and that doesn't work. And I think we've done a similar kind of policy error right now, which was all these things. Now, I think 20 years from now, I know you've had Mike Munger on the program, and 20 years from now, we will have the scholarship, the evidence, and whatnot for someone to do a thorough public choice analysis of what went on, who benefited who at what expense and all that stuff like that. We don't have that right now. We don't know the details, but we have a lot of people run around and say things about Hank Paulson because he was a Goldman Sachs guy and things like that.
Awkward.
It's awkward, and whatnot. But we really don't know. But I will tell you this much: what we do know is that Paulson's prior is that these institutions are so venerable that if they go, the whole system goes.
Right.
And that's what I think you have to understand what was going on. So when Bernanke, let me be honest about this. Bernanke, when he became Fed chairman, I was actually fairly elated because I figured we haven't had anyone who has as much knowledge about the monetary policy and the Depression ever be the head of the Fed.
Yeah, it's
ever.
great.
He's just phenomenal. So in their mindset, their eyeglasses that they wear going into it is that these are venerable institutions that if they go, then the whole system goes. And as a result of this, I think that too big to fail mentality, too important to fail, dominates the way they've approached all of this all along, and also why they've ramped up the crisis talk about it, right? Because whereas if we step back from that idea for a second and don't think of these as institutions that maybe while they're venerable at a point in time, but they need to constantly be on their feet to keep that. So if you think about like Arthur Andersen and the Enron scandal, imagine if Arthur Andersen was the accounting agency, right? And somehow it's revealed that they're not doing a good enough job, and then we said, we can't tell everyone about that because
we can't let Arthur Andersen fail. They're one of the they're one of the big five.
Yeah, all accounting practices in the world will collapse, right? And so one of the most important things about markets, which don't get talked about enough in our technical discussions about markets, is in fact the reputation mechanism of firms, and the good reputation and the bad reputation. And the sad part is that like us as people, we can use a lifetime to build up our reputation and lose it by one act. One act like that. And that's what happens in the markets. Markets make people have discipline. And if we don't take away, or if we don't allow that discipline to take place, which is what I would argue is going on at the moment, then what we do is we just reinforce the non-accountability and the non-calculability of these assets that's going on, and it slows down the adjustment process. So it actually makes it more painful than what we went through.
To me, that's the Milton Friedman point. It's a profit and loss system.
Yeah.
It's not just a profit system. You need profits to encourage risk taking. You need losses to encourage prudence.
I think to be honest with you, this is the really bad timing. Milton Friedman passing away, and then having this. But Anna Schwartz has been fantastic on this issue, as she's pointed out. Bernanke knows the Depression inside and out, but the problem is he's fighting the wrong war at this time. He's fighting a monetary contraction that took place in the 1930s when we didn't actually have a monetary contraction this time around. And so Anna Schwartz at 90 plus has been absolutely fantastic on this issue.
Let me mention a point about language, and then I want to give you another challenge. The language point I want to make sure people are aware of is that the word market failure gets thrown around a lot. And market failure doesn't mean failures in the market. Capitalism and a free market worldview, or an Austrian or liberty-oriented worldview, firms make mistakes. People make mistakes. They go out of business. They take too much risk. That happens all the time. We don't suggest people are perfect. That's not a market failure. It's true you failed. You're out of business, but that's not a market failure. Market failure in economic jargon is a reference to a systemic distortion that markets themselves are causing,
right,
and that are due to the fact that the natural incentives are flawed, as opposed to the imposed incentives of the rules of the institutional framework the government creates. So I just want to make sure that distinction is clear. So people argue there's a market failure because people have there's externalities, say, or there's something is a public good, and markets don't provide those very well, and that may be true. Our response then is, well, is there going to be an incentive for government to provide them well or accurately? That's the distinction I think is important for for our worldview.
I think that's an important point because a lot of people will say things like we've proven that the market doesn't work and stuff. But I'd say that our current crisis is similar to saying that if we had a system of a bunch of rent controls and there was a shortage of housing, that then you would say somehow the market has failed to provide adequate supply of housing. When actually the reason why we don't have the housing supply is because of the rent controls that are in there. So it is a government failure story as opposed to a market failure story in the particular instance.
And the even more depressing example of that for me is healthcare. People always say, look how bad our healthcare system is. That shows you can't leave the market in charge of healthcare. Well, we don't have a market anything remotely like a market system in healthcare, as our recent podcast with Stephen Lipstein pointed out.
It's a tough issue, Russ, with this because, on like to go back earlier, Bear Stearns, as you pointed out, why did they engage in this behavior? Why weren't they more, risk management or more prudent? Well, the reason I think that you have to explain that has to do with that they face an incentive where the downside risk was not that big to them because they knew that it was, like the story in the Schiller story is that people thought housing prices would never come down ever again.
That's not true.
And that's not true.
People knew they could come down. I don't believe that.
It's that they didn't feel that that the bad side of the risk was going to ever come due precisely because it was going to be insured against by the government-sponsored agency.
I don't agree with that. I don't think that's true.
You don't think it's a moral hazard?
No, I don't. I don't think anybody at Bear Stearns, for example, figured they could be extra risk-taking because they were too big to fail or that the government would always bail them out or the government would bail out Fannie and Freddie. If they were holding Fannie and Freddie paper to a large extent, which they were holding some, obviously, but if they were holding a large amount of that and were aware of the fact that the government wouldn't be able to, say, guarantee all of it, but of course the government would eventually make it good, that argument I can accept. But I think they just made a mistake. I think there's this. I think the history needs to be written on this as to how much lack of transparency. There's a lot of complexity to this. I don't think it's as simple as you're saying. I agree with you. I don't think it's as simple as saying, well, housing prices were going up. They didn't worry about it. No, I think they worried about it a lot. They obviously didn't worry about it enough. And the more you study these assets, the more ingenious I'm struck by how they were constructed. They were quite clever as a way to insulate against risk. I think there's more to the story. I think people were aware that housing prices would come down. I don't think they were aware of what the consequences of those were going to be in this situation compared to the past. But that's another story, and I want to put it to the side.
Okay, yeah.
Let me. We've got about 5 minutes. I want to challenge you. You've told a very interesting story today about the Austrian view of business cycles. This idea that credit expansion, the over provision of credit, the artificial lowering of interest rates induces resources to flow into particular areas that get distorted prices that cause an ultimate correction to take place, and the pain of that correction is not straightforward. That's the way I understood it in a nutshell, the Austrian theory of business cycles. Yet, that theory has not gotten a lot of respect from mainstream macroeconomists. So, two questions. One is, what would a so-called mainstream macroeconomist say in response to the Austrian theory? Because the general, they laugh. I think they dismiss it. Oh, that's something from the 20s, the 30s, and we don't have to pay any attention to it. But does anybody take it seriously? And what's their alternative story? How do they explain this? You said, for example, that the monetary story of booms and busts, the monetarist story of booms and busts, and the Austrian story are not inconsistent with one another. But the Keynesian story, which has been the mainstream, half of the mainstream macroeconomic community for the last 30, 40 years, or even longer, what's their response to the Austrian theory, and what's their explanation of booms and busts, and why do they hold those views?
Well, I think that, to start with this whole thing, we got to go back to what I said in the beginning. There may be macroeconomic problems, but there's only microeconomic explanations and solutions. And so if you think about the way the narrative or the story sort of plays out, in that sense, you have to sort of tell a story that both begins in an equilibrium and then has a shock to it that then brings about a outcome outside of equilibrium, and then the process of adjustment back. And combination of that, the agents are rational at each of the points in the story, as opposed to becoming delusional or something. And so in that sense, it has to be sort of a relative price story with incentives and going all the way through. So Bob Lucas, as I mentioned earlier, after he did the Lucas critique, and in the 1970s and into the early 1980s, he had the idea of the equilibrium theory of the business cycle, in which he followed Hayek's pre-Keynesian strictures, which is that in order to explain unemployment, you have to begin in a world of full employment, explain the distortion to the system to explain why unemployment comes about in the first place. And he had this idea of the islands and the difference between relative price adjustments or confusion. And the
islands were little nodes of economic activity that didn't communicate perfectly
with one another. And so you have, relative prices and a general price, and there's a confusion between the two of those, and that confusion causes problems. The problem with that idea is that it's hard to work that model all the way through with a consistent rational expectations perspective, because you should be able to pierce through the difference between the relative price and the general price. And so Lucas eventually moves away from that model, and then you get real business cycle models that develop later on. The Keynesian story, as you mentioned, that's unmoored to human choice. It's aggregate variables, right? It's aggregate demand failure. And to the extent that human choice gets brought in, nowadays it gets brought in through behavioral economics and the idea that people get deluded, they have psychological...
They get giddy.
Yeah, and so I don't think it's really a quote-unquote economic explanation. I don't know if that's an answer to you, but the difficulty...
Let me ask it a different way then. What would be the Keynesian response to the story you told? Do they take that seriously?
They would argue that the conditions under which markets work require such strict assumptions about rationality and the institutions, the competitiveness of the market and whatnot, that in the absence of those hyper-rational agents and perfectly competitive markets, market agents instead are in fact caught by, their alluring hopes and their haunting fears, and they end up by getting, sort of diluted, and the market is unstable, and that's what we've seen. And so the only way to fix this is to have government as a corrective to that, to provide the stability that economic actors themselves can't provide. And so I think that part of the reason why the Austrian theory gets poo-pooed by people is because it's been tied up with arguments that other people think have already been settled, arguments about a gold standard, arguments about the particular mechanism that we were talking about before, that it's just production, investment, and now we have this consumer side and whatnot. But I think if you break down the Austrian story into the proposition that, money is non-neutral and the adjustments take place in a ragged way through relative price adjustments, that if you look at the capital structure is made up of particular capital goods that are both heterogeneous and have multiple specific uses, and then you look at the way in which distortion in the relative prices can distort that capital structure, then the Austrian story doesn't become all that unusual from any sort of coordination story. And you look at the Austrian theory of the trade cycle as a long history of coordination stories that also make sense in Axel Leyenhoef's work on Keynes and the Keynesians, that the story that he tells about the Vixelian connection is very similar to the story that Hayek and Mises were telling. And so you see the Austrian theory not so particular to the Austrian school, but instead to a general idea of what coordination of economic activities takes place through time, and that you can have distortions that then need to be corrected. And so therefore the Austrian story is just one of the other sort of particular stories about coordination failures that may take place in an economy, in which puts the burden on the idea that it's a particular transmission mechanism of a credit expansion that causes that story. But there's multiple ways in which we can be distorted by government activity.
I want to let our listeners know that we'll have links up for if you want to read more about the Austrian theory. We have Mises' 1912 work, The Theory of Money and Credit, at the Library of Economics and Liberty without charge. You can read it online. We have other works on Mises and Hayek on our site that'll be available, as well as I hope to links outside of our site. And in addition, hope to be interviewing a Keynesian in the near future, if not next week, to give a different perspective. My guest today has been Pete Boettke. Pete, thanks for being part of EconTalk.
Well, thanks a lot, Russ.
This is EconTalk, part of the Library of Economics and Liberty. For more EconTalk, go to econtalk.org, where you can also comment on today's podcast and find links and readings related to today's conversation. The sound engineer for EconTalk is Rich Goyette. I'm your host, Russ Roberts. Thanks for listening. Talk to you on Monday.